We've officially entered the holiday season with the Dow and NASDAQ moving in opposite directions. We're here to give you insights that'll help you navigate your financial future. I'm your host, Andrew Brill. Let's see what our experts had to say this week. This week on Speak Up, Tom Lee joined Anthony Scaramucci. Tom gave us a prediction for Bitcoin and what coins besides Bitcoin we should be keeping an eye on. He also thinks with more of Gen Z getting into the market, the S&P will reach 15,000 by the end of the decade. And have we thought about the downside of AI since there are no ethical boundaries?
You are genius level at predictions. Okay, so last time I had you on the show, Bitcoin was in the mid 50s to high 60s range. You said we're going to 100,000. I said, when are we getting to 100,000? You said by the end of the year. Okay, yeah. So why did you say that? What did you see? And what do you see for Bitcoin over the next 6 months?
Part of the reason we have stayed constructive on Bitcoin is the price is following closely the prior halving cycles. The halving cycle, for your viewers, is when the block reward gets cut in half. That happened earlier this year. So there's a reduction in new supply. And the sweet spot of that price gain as supply is cut starts to happen towards the end of this year and then into next year. And I think that has supported why we expected Bitcoin to be 100,000. And over the next 12 months, I think something over 250,000 is possible, but maybe highly probable based on just this following this price cycle. The second reason I think Bitcoin has maybe more upside than that is because the new administration has run on a pro-Bitcoin platform. And I think that the possibility of the U.S. not only legitimizing Bitcoin, but making it a strategic reserve asset, I think raises what would be the possible price scenarios for Bitcoin. Because if the U.S. government, as they intend, ultimately gets to 1 million Bitcoin, they'll be the largest holder of Bitcoin in the world. And they'd exert enormous positive influence on legitimizing Bitcoin. And maybe I would just add to that, it's almost like taking a playbook from MicroStrategy, because MicroStrategy has proven that using Bitcoin as a balance sheet asset has really created a lot of value for MicroStrategy shareholders.
So I'm a Bitcoin holder. I believe you're a Bitcoin holder. There are other coins out there. Some of those coins have not done it well at all. They've diverged from Bitcoin. And there's a few coins like Solana that have done quite well. I had an investment in something that I think you did some research on called Algorand. Unfortunately, has not done well. So away from Bitcoin, are there things that you like? Are there tokens that you think from a utility perspective, from a use case perspective, that you like away from the store of value Bitcoin?
Yeah, I mean, the answer is yes. We've recommended to our clients that if they didn't want to be Bitcoin only, that they could look at Bitcoin, Ethereum, and Solana, because we put those largely in the same category as like sort of core cryptos. Mm-hmm. Yep. We are also entering what I think is alt season. Next year is really when I think the crypto market could broaden. And this is where those who are really experts on crypto, and I know you run a crypto fund, actually are gonna have some alpha, because that is actually when many altcoins could do really well. I think that the stronger Bitcoin is, the stronger the ecosystem becomes. And so many of these utility tokens and things that are tokenizing really start to have a lot of expected value. But I don't follow this as closely. Sean Farrell is much closer to sort of how to play alt season and, of course, Skybridge.
You've previously predicted that the S&P would reach 15,000 by 2030. And what I loved about what you said is it would be factors like Gen Z finally entering into the market, advancements in AI. You sticking with that? Have you moderated it in any way? If so, how? And what are some of the key drivers that support your forecast?
Yeah, it's that's still our case. Our base case that we're in an earnings driven cycle, aided by AI, also supported by this prime age workforce surge coming from millennials and then also Gen Z, because those two generations are larger than Gen X. So Gen X is the generation born between 1960 to 1980, roughly, and those folks are, just in the heart of the prime ages now, and now they're exiting, and now you have two huge generations behind it. So think of it as like a second wave driving further growth. S&P earnings next year are roughly 300 for, let's say, just sort of simple measures, and so that's why S&P 6,000 is just 20 times earnings, right? Which I don't think is that demanding. By 2030, we estimate S&P earnings could be 600 to 650. Okay, and I think multiples will be higher because of the larger share coming from AI and technology earnings, which naturally have higher PE multiples. And so if you just apply a 20 to 25 multiple, you're getting, 15,000. So I know it sounds like people say, well, 15,000 sounds crazy. And 2 years ago, it might have sounded crazy, even though we had, that forecast was in place more than 2 years ago. That forecast has been in place probably for 5 or 6 years. But, now that we're at 6,000, we're that much closer to 15,000. It's not a quantum leap any longer.
How do you assess the impact of the artificial intelligence? And is it all positive? Could it be dystopian? Could military adversaries of ours get a hold of it? Could someone figure out how to put an artificially intelligent worm into our Pentagon or our power system, or are you just not worried about any of that?
I would say, if based on my conversations with our clients and with other sort of folks following this, I do think we're underestimating the negative consequences of AI.
Okay.
Anthony. Foremost because in a human, like in our human intervention endeavors, we work with ethical boundaries, because even though there might be a shortcut, like let's say you're waiting for coffee, you wait in line and other people are in front of you. But in an AI world, there's no benefit to being ethical. So that in the AI world, that machine will just cut the line in front of everybody to get coffee. And I haven't seen any attempts to create ethical boundaries within AI, especially other nations pursuing it. So to me, this means there's going to be much greater risk of cybersecurity hacks. And it's going to be much harder for us to protect our identities in this world of AI and social engineering and generative AI videos. And it'll be very easy to spoof people. And so I think profits are going to do fine. There's going to be a much higher cost in the economy around cybersecurity, and already JP Morgan, 7% of their activity, well, all banks really, 7% is now suspicious. It's actually been rising. So in a world of cybersecurity, banks are kind of losing the war because there's more fraud now than less. And so I think that makes crypto so much more important because it does secure your information. I think that's one solution, but so I think there's a lot of risks, actually, personally. I think if you unleash AI systems in the financial market, there's going to be a lot of people who make dirty trades that trick people and spoof people. and there'll be fake headlines because that's how you manipulate markets.
Are you concerned about your financial future or think your investments could be doing better? I'm Andrew Brill, one of the hosts here on Wealthion, and I've been there. Not sure my money was in the right places. It's why I've gotten help from a financial advisor. Maybe it's time you think more about your financial future or get a second opinion about your investments. We've made that process easy. Simply go to wealthion.com/free to speak with one of Wealthion's registered investment advisors for a free, no obligation portfolio review. Again, that's wealthion.com/free. I'm now less anxious and confident I can achieve the financial goals I've set for me and my family. Top Wall Street analyst and CEO of Strategic Research Partners joined us this week. He noted post-election optimism with single-digit earnings expectations. He also wondered out loud how Donald Trump's Wall Street picks will affect debt and inflation control. Jason also talked about the housing issues the country is having with high mortgage rates and prices, and should there be a cap on interest rates? I know you noted in your research that you sent over to us that now that the election has passed, things have calmed down a little bit. Obviously, the markets went crazy, and earnings were at the end of earnings season. You believe that earnings into next year are going to continue to be very good.
Yeah, it looks like it, especially given our view of the economy, which is to say the chances of recession, in our opinion, next year are pretty low. Obviously, profits are in nominal terms. So if you have a little higher inflation, it tends to imply higher earnings. The issue really comes if that higher inflation results in higher long-term interest rates, and then whatever you get on the earnings side, you tend to give back on earnings multiples. But I do think the earnings are probably not going to be as good as what the street is expecting, which is about 14% increase next year. But they'll probably be in the high single digits, something along those lines.
So, and where does that sit with normal? 14% growth is probably a little bit higher than normal. Where does single digits or high single digits, where does that sit in terms of normal?
Well, over the longer term, the normal is about 7% nominal for profits. So we've definitely been over earning. And a lot of that, I would say, at least recently, has been due to a relatively small group of companies. If you excluded the Mag 7 from the earnings calculations, you'd probably be below normal. So if you took the S&P 493 versus the Mag 7, right, you'd probably be in the 4 to 5% range in earnings growth next year, as opposed to 13 or 14. But those companies are earning so much cash, or earning so much in terms of earnings, but also generating so much cash that it all evens out for the market as a whole to something that's above average.
You mentioned CapEx spending. Is that an assumption that interest rates will continue to come down, so companies will be able to borrow to spend, or is that you think that people have some cash around to spend on?
I think they have some cash, and I think the range of outcomes from the election was so wide, in my opinion, with the two candidates, that it was pretty prudent, I think, for a lot of companies to hold off on any sort of big capital expenditures until they knew who won. And then they could decide whether they would proceed or hold off or change the plans. So now that it's over and there's some certainty, and I would argue, not to be overly political about it, I think President Trump winning is better for capital formation than if Vice President Harris were to have won. I think all those things bode well for CapEx. I'd also say that corporate credit spreads are very, very tight. And so interest rates don't necessarily have to go down, but companies are able to fund themselves at very, very attractive rates relative to history. And so that helps out as well.
You've heard some of the names, I'm sure, about the people that could possibly head the Treasury. Do you think that that's a possibility, that they'll think about this differently? Donald Trump is looking at Wall Street people to head the Treasury. Do you think we could be entering a different time and a different way of looking at things?
I think so. I really do think so. And I think I don't want to cast aspersions on the current Secretary of the Treasury, but in my opinion, she's behaved in ways that are more politically oriented, more politically motivated than perhaps in ways that would be in the benefit of the long-term interests of the economy and the American taxpayer. And I think it's good that you have people with market experience, especially now, people with market experience in that role. We just had a conference 2 weeks ago, or a week ago. It seems it's like 4 days ago. I don't even. It was in London. I think it was last Thursday. I've been everywhere. But we had it with Liz Truss, and Liz Truss, former Prime Minister of the UK. And we had her speak to our clients specifically because of this idea that she was there when the bill came due in the UK, when the bond market vigilantes really kind of forced her hand, and that's important. It's instructive. And again, U.S. has reserve currency status, so you get away with a lot of bad behavior when you have the reserve currency. But it's not. There are limits to what you can get away with. And I think having a markets person in there makes a lot of sense, because this is going to require a certain amount of flexibility, I think, intellectually, and a good understanding of the markets to get through this without a lot of pain.
It's and talking to you about this, it occurred to me that if you do the longer, even a 20-year bond, you add a new group of people like retirees who say, oh, you know what? If I can do 20 years at 5.5% or 5%, I know that's coming in. This is a whole new group of people you have buying bonds. So, and talking to you, that light went off in my head. I don't understand why it doesn't go off in the Treasury's head.
I think it's really I honestly believe it's political expediency that at the margin, it kept the deficit a little bit lower by issue, especially when the Fed was engaged in QE. It was just cheaper to issue shorter term debt. But the problem is that once you start to have an inflation problem and the Fed has to raise rates, that benefit turns into a detriment, because now the weighted average cost of our debt, not to get too in the weeds here, the weighted average cost of our debt is below every part of the yield curve. So no matter where we funded it, even if we continued to fund it with bills, our interest expense would rise because we have committed ourselves to so much short-term funding that anywhere we would fund it, it would increase the interest expense on our debt. And so, again, no one, in terms of, not to be overly simplistic about it, but certainly any person that was taking out a mortgage, if they had an ability to fix their long-term interest rate at very low interest rates, would take it out as long as possible. Uncle Sam basically took out an adjustable rate mortgage on its future, and it can get away with it, but it's not without cost. And the cost is the potential for higher government spending, higher deficits, higher inflation in the long term.
It seems to me that that's the smart thing to look at, although some would look at a flat screen TV or a trip to Barbados as a necessity. It's really not. But right. Those are the things that are necessary. I mean, housing, which is totally out of control, and with the 10-year, housing prices, mortgage rates, they're all way higher than a lot of people can afford. How do we get that under control?
Yeah, no, I mean, the irony really is that mortgage rates have increased meaningfully since the first Fed easing in September, right? And so they're up about 40, 50 basis points, if I'm not mistaken. They're close to 7, I believe, right now. And it's a very tricky problem, because there are a lot of reasons why there's a certain there's a bottleneck in the housing market. Part of it is just because interest rates rose very quickly, and so you have a lot of people that are, quote unquote, stuck in lower interest mortgages. I also think the immigration policy over the last 4 years has not helped the housing market, right? Because you have, depending on who you're listening to, another 15 million people in the housing market. And so that soaks up some supply as well, right? So everything is at the margin. And so here it's not a particularly easy thing to fix, right? Or it takes time. Their estimate is that we're probably short somewhere between 4 and 5 million single family homes. We we manufacture single-family homes at a rate of about 1 million a year, maybe a little less than 1 million a year. So the bottleneck in housing is meaningful and is not easily fixed. And so it's really, I wish there were a better answer, but it's really more of a function of time more than anything else.
So I was reading about credit and credit cards, and obviously President Trump wants to put a cap on credit card interest. And I was reading that could cause credit card companies to start canceling credit cards. So
Yep.
that would tighten credit, and that would be a drain on the economy as well, because now people can't spend as much as they used to because they don't have that credit. They don't have the cash, but they don't have the credit either.
Yeah, I'm not a big fan of price controls, and whether those are price controls on groceries or price controls on money, on interest paid on the cost of money. And so I understand the impulse because these interest rates are, pretty much in the usurious levels. You're looking at 25%. By the same token, again, it's as you're pointing out, the credit is only available probably at those types of interest rates for some people. And so I think, again, I'm for free market capitalism. I think markets tend to do a better job of organizing an economy than the decisions of relatively small groups of people. Especially small groups of unelected people, like at the Federal Reserve Board, right? So, I would rather see just more market influence in the economy. I think the incoming administration is much more pro-market in that regard, but I would resist the temptation to try to fix everything via the government, because I think, as we've talked about before, once you start going down that road, it's very hard to get out of it. We should be moving back to less government, more markets, and then, of course, having a strong rule of law, punishing the bad guys, all of that stuff. But I think the price mechanism, the incentive system works exceedingly well.
I thought it was a great idea, but I didn't look at it from the credit card company side, right, where they said, okay, you know what, we'll just cancel credit cards. So it's a very slippery slope, maybe not 10%, 15%, they have to be able to make their money, obviously. So
right, you're balancing, the credit card companies, and again, no one's a big fan of credit card companies. I mean, in terms of what they're charging, and I'm not defending them necessarily, but it's a business, right? And they have to balance the potential for loss with the interest rates that they pay, right? And so that's kind of the way it works. And again, as I said, I'm kind of more for free markets than anything else.
Founder and principal market strategist at RW Advisory, Ron Williams, spoke with us at Wealthion this week. He talked about market risk and can we go from pullback to collapse, the upside and downside to Bitcoin, and how to minimize the risk in your portfolio was a topic of conversation, along with what to expect in the coming commodities supercycle.
So these financial markets, and I'm going to start with the S&P, it's like a runaway train. And it doesn't matter what you look at, like so many stocks, Bitcoin, so many other asset classes. They're just making new highs every other day. The S&P is at or near 6,000. It's up 25% on the year. And why don't we just start here with the U.S. market? So what are your views of the U.S. market? Do you think it continues to go higher into the new year?
Yes, for now, the market remains euphoric post-election. However, the view on risk proxies, S&P 500 case in point, is buy the rumor, sell or fade the fact vis-a-vis the past election. So November 5th was the expected Republican and Trump win. That's what we see here on our follow-up visual of interest rates, long-term 10-year interest rates resurging higher from lower levels, but also tracking back then the Trump Republican win odds. So that was not so much the surprise factor. What was the clear decisive and broad win in terms of the red sweep, and the policy market implications in terms of fiscal policy, potential inflation tailwinds, as well as revived animal spirits for equity markets and deregulation friendly environment for Bitcoin. But what all of this means is that the market has just continued to get hot and euphoric into and then after the most important event risk in many years, and arguably even more than that compared to other elections. And so what that will likely lead to is a overheated, overbought situation where those risk proxies that drove up into the election start to unwind into inauguration as part of a profit-taking and reality check on the policy rollout to come. And that's something I can add more to in terms of the statistical work that we do here at RW Advisory on election patterns, behavioral sentiment, and markets in general.
And Ron, the other thing that really stood out to me was the pullback that you're looking for. It's not much of a pullback. It's less than 5%.
Yes, absolutely. So that's purely in terms of clearer signals as to whether this market holds up or not. In terms of a much more bearish risk scenario, certainly the one that we are following is the 2008 global financial crisis. Now, that's going to concern a whole lot of people hearing me say that, and so I do say that carefully. It's not. Let me back up with a disclaimer. It's not a repetition of 08 or any other time in history. It's the pattern rhyme that we're looking at. And so if you look at this chart here, the most important pattern rhyme comparison is what we term as a bullish trap signal, i.e. excessive euphoria on elevated leverage and typically low vol, all flipping the other way when ultimately market consensus gets it wrong. And a lot of that portfolio positioning is forced to sell. It's not a choice. It's a pressure reversal that happens in the market. The same thing happened in 08. We had an all-time high just after a Fed pivot after many years of doing the opposite. And then we had a three-stage corrective pattern: fall, rally, rest of fall. But that middle part of the rally was an all-time high and ultimately a head fake, which then became a bull trap signal. That then led into what became the historical top of 07 into 08. It was a 6 to 12 month topping pattern, but it began in the second half of 1 year and then developed over the first half of another year, which I think is what is likely happening here and now between 2024 going into 2025. And this is typically when everyone is most bullish, most euphoric, and that's the point. It's non-consensus. It's not meant to be in line with everyone's thinking. It's the exact opposite. And for that reason, we get caught out. We're blindsided. And typically, it can be quite a turbulent and volatile change in market environment. And just to add, what would confirm this pattern on S&P 500 right now is a move back through 5670 and then 5400. So not just 5%, 10%, 20%. And of course, if you go back to bear market analogs, 30 to 50% in terms of the big bears. And just to add, one of my educational good, bad, and ugly charts is looking back at bear markets, the small ones that are short-lived, such as 87 and 2020 COVID, which recovered way faster than anyone expected. Then the so-called bad during 2000 and 2008. A lot of people allude back to 2000 in terms of the tech concentration risk. And then last but not least, the one that I encourage everyone to have a strong cup of coffee or something even stronger. On the far right, the ugly chart, which is basically sideways roller coaster, volatile market environment, such as the 1970s that included an oil shock and ongoing geopolitical risk premium. And then lastly, of course, the infamous 29 Wall Street peak and crash. Now, our view is that we're likely going to get a hybrid of the bad and the ugly. I'd love to say it's probably going to be good days ahead and summer's going to last for as long as possible. I'm here in the UK and I miss summer, so I'm more than happy to project some of that bias onto the market. But the reality is we have to go through different seasons of the year, and markets do the same. And given that we've had such a strong bull and business market cycle, the autumn and winter season is long overdue. And this time will likely be a hybrid of the two that I just mentioned, partly because of the inflation effect that is building up with all this debt and just general exuberant market moves. So that will need to shake out, reset before a healthy bull market recovery follows.
Now, you showed in one of your earlier charts that one of the strongest asset classes out there is Bitcoin. It's up over 100% on the year. And I can't get over the amount of chatter on X relating to Bitcoin. But what are your thoughts here? It's very close to going through 100,000. Does it keep going?
Yeah, I mean, clearly this has been the best performing asset, bar none, just because crypto is crypto, and when it goes up, it really does. It rockets. And just since the election of November 5, it's up more than 40%. Just since then, year to date, even more. Now, and just to add, that's partly down to the crypto deregulation story that is likely to follow a Trump Republican presidency. So there is policy tailwind as to why Bitcoin is strong now in the crypto complex in general. In addition to the halving cycle, and in addition to just a very strong and resilient trend. But nothing goes up in a straight line. If there's one thing I've learned in all these years of studying and trading markets and engaging with clients, is exactly that. So do expect a zigzag behavioral pattern, even in strong markets like crypto. The average volatility, daily average volatility on Bitcoin is 20%. So while it looks super cool on the upside, it can equally surprise on the downside. And I think most prudent crypto and Bitcoin traders know that. That's the price they pay as part of the risk reward profile. But I would caution those that go all in late into the move, because it's just when you least expect it, that the market strong trend gets overheated, unwinds as people take profit, and ultimately as momentum rolls over. And that is true both from the price momentum indicators I'm looking at on Bitcoin and crypto, but also the cycle model that I follow, which suggests that we could get a little bit of a mean reversion risk coming into the new year on Bitcoin and most of the risk proxies that ran up into the election. Last thing I would want to encourage is a smart diversification across not just Bitcoin, but also gold. It's otherwise known as BOLD, bold, a blend of the two. And if you just think of an 80-20 allocation, 80% gold, 20% Bitcoin, or less, depending on if you're depending on how supportive you are on either of those markets. But that is a more prudent and better diversification of your risk reward profile across both markets. I wouldn't suggest going all in on crypto now, because I think most of the move is done and we're likely going to get an unwind soon.
And do you have specific targets for the upside and downside?
Yes, so upside, we're at it right now, 100,000. It's a big figure. Celebrate. This is something that 6 digits. We've been, many crypto bulls have been talking about this for some time, and we've hit a milestone. Can it go higher? Yes. And I don't think there'll be too much surprise to the upside because it's pretty much expected and baked in terms of the crypto dynamics. So certainly I'm happy to speak more to the upside once we get a shakeout, but not before, just because I think the mean reversion risk is probably stronger at this stage. And on that point, I would say at the very least, move back down to the previous all-time high at 73,700 is likely. And potentially lower than that, the 50,000 mark. So we can literally swing the other way and still be demonstrating a healthy bull market correction with a lot more upsides ahead. So if you just think about it, that alone, those levels alone are big enough. Maybe that's a buy on the dip opportunity for crypto for those who maybe are feeling a little bit of FOMO and want more upside ahead, or maybe people who just want to profit take and celebrate the year-end season.
So I want to ask you about this commodity super cycle, and oil is currently trading around $70 a barrel. Where could oil go to during this super cycle?
Much higher. This can more clearly be seen if you look at oil stocks. Oil stocks have been strong for some time, although clearly they hit a ceiling and unwound. But look at what happened in 2022 when there was last a surge in inflation and rates. Oil stocks surged up higher. We didn't really see it in the underlying crude oil market. Having said that, what's changed now is certainly we have an administration, U.S. administration that is more pro energy, as that new saying being revived, drill baby drill, being clearly supportive for the market in terms of more production. Look at the new appointee that has come into office now that is also very supportive of that market, but in combination, not just policy, in combination with ongoing geopolitical risk. Last time I checked, Europe is still in a conundrum, and we'll see how that plays out. But also the Middle East is still hot. And latest headlines are that there might be an Iranian retaliation strike. Iran being a strong oil producer, that would be disruptive both for oil and the global economy. These risks remain. They're tail risks. We don't know if they play out and if so when, but certainly that does add a premium to the upside in oil, which from a price dynamic perspective, last third and final factor, is already oversold, range bound at key support. So even from a chart tactical perspective, surprises are likely on the upside in terms of what I just mentioned, policy-friendly environment vis-a-vis the new administration, geopolitical tension, which remains there. Look at the latest headlines. And then, of course, the chart and tactical overlays, which are oversold at support.
And gold can do very well during an inflationary environment. Do you have a target price for gold?
Yes, absolutely. I mean, certainly we could see further upside into the 3,000 mark. That's the next psychological milestone level to the upside. Also, there's an analog which I don't have ready here, but I can bring on for future discussions. Oil and gold, but more to your question on gold, typically spikes during uncertain and disruptive times. In 1980, gold actually spiked by several $100s in just a few weeks on the back of double-digit inflation as well as geopolitical tensions. That also happened but to a lesser extent in the 1970s. So go back in time and gold really does rocket in a short space of time if uncertainty continues, coupled with further inflationary risks and devaluation of currency. Remember, a big part of the gold trend up is currency devaluation. The money in our pockets are losing value day by day, no matter what we think or believe. And so gold is the hedge reflection of that. And we're now starting to realize that in terms of gold upside this year, 2024, central bank demand alone has been at record levels and clearly also supporting. And we're only just starting to see ETF flows starting to build into the gold market.
On Thanksgiving Day, we heard from Ram Ahluwalia, founder and CEO of Lumita Wealth. He explained to us the difference between value and growth stocks. He also touched on the current rate cutting cycle and how it is affecting baby boomers and their investment decisions. He also discussed investment vehicles that could be a good bet. I want to ask about that value stocks versus growth stock. How do you differentiate between the two?
Sure, it's an excellent question. So when I think about growth stocks, I think of stocks that on average are 50% plus in terms versus their median PE ratio for that category. Okay, so if you're a high multiple stock, simply put, you're a growth stock. If you're a low multiple stock, you're a value stock. It's a very simple, clean distinction to make. Growth stocks tend to have higher earnings per share growth than value stocks, and investors pay for that earnings per share growth in the form of a higher multiple.
That's right where we want it. It's like, look, you know what? We're not going crazy. We're not going down. We're just, steady ship.
Arguably, we were right where we wanted to be before the rate cuts, right? So now we're adding some gas and fuel to the fire. And over the last year and a half, we've really developed this boomer economy where we've got retirees living off of T-bills and they're spending. If you go to your local restaurant, the restaurants are packed. Restaurant stocks are quite expensive. And you can usually spot like a grandma or grandpa around the table and they're probably paying the bill. So now with rate cuts and treasuries paying less, that means less income for boomers. All right. So that means for retirees especially. And that means you're going to see a shift in spending behavior and risk-taking behavior. And so you're starting to see dividend paying stocks that are going up. So grandma, grandpa now being forced to rotate from treasuries into equity markets, which have a lot more risk, where you're at the top decile of valuations now. And I don't know if that's the right move because the economy, adjusts to the prevailing set of circumstances. So when you suddenly change one variable, then the economy needs to go through this adjustment process again.
So the shift, are you seeing a shift in some of those things where, the older people are taking money from one place and putting it in another to, I guess, keep that dividend?
We'll see. It's too early to say. I hypothesize that we're going to go see that. So you might measure it in travel and leisure spend and demand for like cruise, of course, restaurants, consumption of golf clubs at Dick's Sporting Goods. So probably a few ways you might measure it. Or, you've seen weakness in, say, stocks like Hilton Garden Vacations and like timeshare companies. So you're seeing some weakness there. But I expect that it'll continue. Look, this will benefit borrowers, of course. And it's going to penalize savers and creditors. So borrowers will be able to benefit. You saw, I should say, a boom in mortgage refinancings from homeowners that took out a mortgage at a higher rate. However, now mortgage rates have crept back up due to the 10-year moving up and concerns around inflation. So the Fed right now has got to be smacking themselves on the forehead and saying, what the hell? Right? They squeezed here and then something gave there. And in a way, it's offset of what the Fed's looking to accomplish because the long end of the yield curve is what funds the housing market, right? Access to mortgage credit. It funds CapEx spending of corporates. It funds and is used to compare the earnings premium and yield that you have in the equity market versus the alternative, which is a 10-year bond of comparable duration. So the Fed is confused. I legitimately think they're not sure the right way to move with high conviction. I mean, how can you? This is a complex story with a lot of moving parts with a set of circumstances that we haven't seen before, where consumers refinanced at very low mortgage rates, and so the sensitivity to interest rates was also lower.
Would you throw bonds into that portfolio as well?
Well, say which bonds? I would put mortgage bonds in that. I think agency mortgage bonds are once again mispriced. I would own agency mortgage bonds because an agency mortgage bond is implicitly backed by the full faith and credit of the United States government. However, they offer a yield that is substantially higher than the comparable Treasury, to the tune of 250 basis points, which is a nothing. So agency mortgage bonds, I think, a really interesting idea. That's one. Treasuries, I'm not a big fan of. You can give away 2.5 points of a 4% coupon on the 10-year in inflation. I also see that private credit strategies can dramatically outperform Treasury yields, right? You can get 10% to 18%, depending on the nature of the strategy in private credit, for example, through funds that provide senior secured lending to middle market companies that have free cash from earnings, but can't get a loan from a bank. So senior secured means you're first to get paid in line, right? So you're on the top of what's called the capital stack. There's also strategies where you have asset-backed financing. You're making a loan and you've got collateral. So I like those strategies. Why would I own Treasury as securities if I can invest in that? Now the answer would be liquidity. So those strategies don't give you liquidity.
So, so Microsoft is going the nuclear route. Do you see a nuclear play at some point? There's a lot of talk about uranium, mini reactors powering things. Do you see, and it may not be tomorrow, it may not be, in a few months, but eventually we're going to have to turn to that.
Yes, it's inevitable. It's happening. 2 years ago it was unthinkable. Now it's inevitable and popular, and Congress is starting to focus on it. The Nuclear Regulatory Commission is starting to focus on it. The United States forgot how to build nuclear reactors. We have something like 80 plus nuclear reactors in the United States, by the way. Haven't built them in decades, but we have a bunch of them. And the United States forgot to build them. South Africa knows how to build them. China is building many nuclear reactors. So China has plenty of energy. And so we have the GPU. China has the energy. We need the energy. China needs the GPU. So our race is on the energy side. Their race is on delinking their dependency on Taiwan and NVIDIA, and they're trying to get around export controls. So yeah, nuclear will make a comeback. Building a plant takes over a decade, though. You got permitting concerns, you got not in my backyard concerns, you have technology know-how concerns. I think it's a great thesis to bet on. It's a very difficult thesis to bet on, by the way. The vast majority of nuclear companies are unprofitable. I see people investing in stocks like SMR, which stands for Small Modular Reactor. The small modular reactor is actually a really good idea. We're going to see that too. You're going to see small modular reactors, not big 3 Mile Island reactors that are right next to the data center. But some of these companies, like the small modular reactor, last I checked, like the CEO sold all his shares, like the insiders are sold out. It's just trading like a meme stock. So you have to carefully pick and choose your spots in the nuclear category. And many of nuclear names are unprofitable. They don't make money. And then the nuclear miners, they can be upside down because they make forward commitments to sell uranium at a future price. But if they cannot deliver and mine enough, which many miners experience that issue, then they're technically short uranium. So you thought you were buying a uranium miner so that you get long uranium exposure indirectly. And it turns out the miner's actually short because they made a commitment to deliver in the future they cannot meet. So they have to go buy in the spot market, right? So uranium is a difficult category to invest in. I do think there are good opportunities there.
Thank you for watching this week's recap. If you need help planning your financial future, head over to wealthion.com/free for a free, no obligation financial review. The link to that right below in the description. And please follow us on social media. All the links are right below in the description as well. If you haven't done so already, please make sure to like and subscribe to our channel. And don't forget to turn on notifications so you never miss a video. Thanks again for watching. If you like this content and are looking for more ways to keep growing your investments, watch this video next. Till next time, stay informed, be empowered, and may your investments flourish.